What you were talking to shift a little bit more to the Federal Reserve and what you were discussing about bank credit and the commercial banks are withdrawing credit from the market, it seems. The mortgage market here is freezing up. The housing market's coming to a complete standstill. Everyone's still projecting a couple more rate hikes here with our own Federal Reserve at the next meeting and possibly in December, 75 more basis points, another 50 basis points. We're going to be at 4.5% on the Fed funds rate pretty soon here in the United States. And as gold and silver investors, we're always wondering, or at least the last 6 months we've been wondering, when does this end? I mean, at some point, the economy freezes up, credit freezes up, the bond market freezes up, and that's when the Fed has to do something. They have to make some sort of shift. Do you sense that we're getting close to that point, or do you get the sense that the Fed's still just going to keep raising rates, and just ignore it all, Paul Volcker style?
Well, the Fed has no alternative but to raise rates until the system breaks. It's as simple as that, Jim. As to the effect on gold and silver, this I think is worth discussing. The reason it has an effect is because the people who are driving the price are basically hedge funds, and if you like, funds of that sort, not individuals, not high net worth individuals, whatever. It is hedge funds, and what they're looking at is a trade which is very, very simple. You buy gold, sell dollar, or you sell dollar, buy gold. Never take delivery. Yeah, that is what they do. So what they're looking at, if you like, is the relative return on the dollar versus gold. I mean, gold does pay an interest, but you've got to actually have it in order to pay the interest. So the further that interest rates rise, the more disadvantageous it is for a hedge fund to go long of gold contracts.
Right.
So that is one thing, one side of it. Now, the other thing to bear in mind, and this gives you, if you like, the right philosophy to approach the whole of this subject. The other thing to bear in mind is that in the 70s, at the beginning of 1970, I think I'm right in saying that the Fed funds rate was around about 6.5%, 7%, and gold was 35, raised up to $42.22 an ounce. At the end of that decade, interest rates were up to 20%. Now, under this idea that interest rates are bad for gold, you would have thought that gold would not have gone up to a peak of $850, but it did. The answer to this really is that while the paper market, which has expanded to suppress the price of gold and silver, is still in charge, then you're going to get concerns of this sort. But we are rapidly approaching a situation, as I said earlier, whereby the Fed will raise interest rates until the system breaks. Now, the last time the system broke, it broke in a relatively minor way, and that was when Lehman failed. Now, I know you might think my use of the word minor is perhaps not justified, but compared with what I see coming, I think it is justified. What happened then was that the price of gold fell from just under $1,000, I think, down to around about $680. Why? Because all the Keynesian boys were running out of what they perceived as risk into what they perceived as safety, which was the dollar. And it was only later that you had the sort of, if you like, the double think, and they thought, well, hold on a minute, this is actually really very inflationary, and perhaps we ought to have gold and silver instead. So you had the sort of backwash, as it were. I think the same situation now. I mean, the uncertainty ahead of the event is obviously suppressing the price of gold and silver, because the Keynesian and monetarist cohort think that safety is in the dollar. And we're seeing this with all the major currencies tanking against the dollar. It's not that the dollar is good, it's just the least worst of a bad bunch. And I think that, at some stage, when the crisis is actually more visible, you will suddenly see that people are actually going for gold and silver. We are already seeing this with withdrawals from COMEX. I mean, COMEX is not meant to be a market which provides physical stock. It's meant to be a market to trade around it.
Yeah.
But I mean, you look at the bullion running out of COMEX. I mean, it's quite remarkable. I'm particularly silver.
We'll put the graph on the screen right now, but it was 150 million ounces in registered a year and a half ago.
Yeah,
it's at 36 million now. I mean, it fell 2 million ounces just yesterday.
Exactly. I mean, Jim, it's a combination, I think, of two things in the case of silver. On the one hand, you have industrial demand for it because it is such a valuable metal in this ESG world, where we're all trying to talk down fossil fuels and talk up, windmills and Lord knows what. That should not be underestimated as a driver behind the silver price. But the second thing is that there are people who do realize that silver is a monetary metal, and when the fiat currency is failing, you better have some. These are not sellers. These are people. These are hoarders. They're stackers, if you like. And we've got the same thing to a lesser extent in gold, because gold does not have that industrial use. But nonetheless, the monetary side of gold is suddenly beginning to come into the fore, which is why you're seeing consistently huge amounts of gold running out of the door on the COMEX market. And not only that, but the cost of refining and processing and all the rest of it gone up hugely for the Swiss refiners. So you can see that the whole situation, mining also is very, very fuel intensive. You can see that the situation is actually working against that mine supply. But the main thing is that the demand is being triggered by increasing concerns in places like Germany, France, China, India, in this country to an extent as well, about the future of these, of the banking system, of the currencies, which they see falling. It makes an awful lot of sense to hoard some gold, and they take on gold not to profit from it. Right. That is not what it's about. It's actually, at the end of the day, you want to have it so that when the currency goes, you've got something to spend with, and that is the vital point. So we are at a bit of a crossroads here, and I would say that this is a wonderful opportunity. I mean, when you see the hedge funds selling down their contracts, going short of silver, gold contracts, whatever, simply because they're scared of rising interest rates and what that's going to do to spreads and all the rest of it. Right. I mean, what a wonderful opportunity for people who actually genuinely understand economics, catalactics, which is really what money is all about, money and prices. I mean, thank you very much. That's where we are.